I chose stock of the day as Sims because it today came out with a profit warning, now tipping first quarter earnings to roughly break even, citing continuing weak market conditions, signs of softness in a previously resilient US domestic market. Last month the company reported, yes, a 70% slide in full year net profit on the back of lower sales and volume prices. But let's talk about Sims, Gaurav, but are they a bellwether that with continuous disclosure, a lot of companies over the next couple of weeks, if they're having a terrible first quarter, are going to have to come out and tell us?
They haven't traditionally been a bellwether, and it's not a stock I would have thought of as a bellwether, but the comments are really important. So traditionally Sims, it's a recycler of scrap metal, and so the key drivers of its performance are how much volumes of scrap it can push through its yards, and then what's the metal price doing? What's the steel price doing? And that steel price, I think, is what's influencing their results at the moment, and that's probably the thing to keep an eye on right now. I think both in China and in the US, there's been a period of sustained strength that is now probably cracking. It's very important for us in particular in Australia. This iron ore price, I've been saying
it's our
for
biggest
about a year,
customer
by far, and there's no competition. It's by far our biggest customer. There are expectations, I think, that China is going to stimulate, and that the same thing we've seen over the last 10 or 20 years is going to repeat. And I don't think that's going to happen this time. I think the inclination and maybe the capacity is different this time. And I'm quite cautious on commodities at the moment. I think you've got to be very selective. This big run-up we've seen in commodity prices, and this constant vocal expectation that China will save the day. I think this is dangerous thinking. So yes, this is probably the first signs of that. I'd be careful. Historically, Sims has not been, I wouldn't have been considered to be a bellwether, but what they've said today is important. It is relevant.
You'd stay clear of it though?
I would, yes, because this goes through huge cycles. The ups are higher and better than you think, and the lows are far deeper and worse than you'd expect. And if this is the beginning of a new cycle, this is not the time to buy the stock. I would actually buy this at the right time. Traditionally, that's been sub $6 is when you kind of want to look at this. So it's got potentially a long way to fall.
Okay.
That's my Gaurav. You know, when you take a cut, he takes it all the way down to the bottom. I wouldn't have said $6, but it is one where there's a fair amount of optimism priced in. This is, I wouldn't say a high quality business, but everything that's been China linked, it's like just basically put a new fresh paint on it and throw it back on the market. We get this story about China doing stimulus. It started in November. Every month and a half, the story comes back. Right? And they have done little bits on the edges. They have cut rates, but predominantly their thematic has been to alleviate cost pressures on the consumers and try and get the consumer to spend more. You got youth unemployment at, I'm assuming 25% because they stopped saying it after 21, 22. So that's, when you're at that level and you're that big an economy, and you've got a problem, what do? You are one of the biggest manufacturers in the world. Nobody wants anything. Nobody's buying anything. So what do? You make more stuff and stockpile? No.
Well, wasn't a previous stimulus was really building infrastructure and housing. So that kept the steel mills going.
That's right.
But they've got too much infrastructure and too much housing.
And then they started to build infrastructure in other countries where they had Belt and Road projects. Now the problem is every country that's on that playbook is loaded up with debt and can't even finance their own debt. So they can't pay for any of these things. So they've got these two angles, they're all blocked. So there's really a struggle to see what China is going to stimulate. So that's why I don't think that, and hence why we've been negative on the China story. And we've actually stayed that.
It's a really good example of the way markets tend to operate. They tend to think in straight line extrapolation, because we don't know whether China, no one knows. We're guessing, right? And the way, when you don't know something, the markets tend to extrapolate historical data and put it through a straight line. And that tells you that the opportunities and the risks in markets are when something changes, when something is different from in the past. And my gut feeling is that that's going to happen this time. We're going to have a different response from China than what we've had in the past, and it's a source of tremendous risk for the market.
And they've been
Instead,
deleveraging for nearly 2 to 3 years. It would make no sense
Yeah,
to
I agree.
reverse that.
But their stimulus now is saving
That's right.
Chinese companies, saving property developers from going bust. So they'll stimulate on the interest rate side rather than
Just go
build
and build
more
nothing.
houses and jobs. It's about saving jobs.
Remember
not
that
growing.
island I said a long time ago outside Singapore, off the Malaysian coast, Forest City? They literally built an island in the middle of the sea and built apartment blocks. The whole thing is empty right now.
Yeah.
And so these are the problems they've got. They built a lot of infrastructure all over the place, but nobody's using it, and they're all in losses. So it's a tough play for them in the short term. I don't think China's going to. I think China's not going to blow up. I mean, look, I've been in the industry 30 years, and I've heard that story from day one.
Yeah,
right?
true.
They're going to blow up next week. They're not going to blow up. Even if they did, we're not going to know about it. China will keep going, but they're not going to be economies of scale. They've reached that level where it's really hard for them to do what they're doing, and it's almost impossible when everyone else is in a slowdown.
Yeah.
So it's a tough play for China. Expecting China to bail out, and unfortunately that is our plan number one in Australia. We just stuff up our policy and wait for China to bail us out.
Yeah.
And I think that's going to be tough.
So you'd avoid Sims. Would you wait till under $6 or?
Gee, that's a long way down. I always used to say, I mean, it'll piss Gaurav off, but QBE and Sims, you always wait for them to get to single digit, and that's when you start looking at it. So I am not looking.
That's been the right advice historically.
And I am not. I look for, and this is nothing scientific, when these things get below $10 to single digit, when they turn from the bottom, I'm buying.
Right.
And because then you get the love and hate thing. But the reality is these are cyclical stocks, and Gaurav's exactly right. When the cycle turns, there's a long way down. So no need to pick the bottom on that.
I buy them I think my thing is 70% or less of asset value, which gets us down to that sort of number. But I'd buy it well below asset backing.
Yeah. Okay. All right.